In this overview, we'll walk through the all-weather portfolio, which is an investing strategy designed to manage risk and volatility through various economic seasons or environments. The fundamental investing insight here is this: investors can construct a portfolio that performs well in varying economic environments, including both high and low inflation and high and low economic growth, using a combination of uncorrelated assets. At the strategy level, the all-weather portfolio invests in U.S. stocks, intermediate and long-term bonds, commodities, and gold. It is considered a simple form of risk parity since it overweights lower-risk bonds relative to higher-risk assets like stocks and seeks to even out each asset class's contribution to the overall portfolio risk. As for the source and the evidence behind the model, the all-weather portfolio is a more simplified version of a risk parity-based all-weather fund offered by Bridgewater Associates and its founder, Ray Dalio. Since its inception in 1996 to the end of 2019, Bridgewater's all-weather fund returned 7.8% annually. The investment thesis behind the strategy is this: the combination of uncorrelated and different asset classes and weightings provide the portfolio with the ability to do well in any economic season or type of environment. The objective is to generate steady returns, limit drawdowns and volatility, thus helping the investor following this type of strategy stick with the portfolio over time to get the most out of it. Okay, now let's take a look at the all-weather portfolio in some detail. As I mentioned, this strategy is extracted from the writings and the interviews of Ray Dalio from Bridgewater Associates. The strategy allocates across 5 different types of asset classes: U.S. stocks, long-term treasuries, intermediate-term treasuries, commodities, and gold. The mix is to provide the portfolio the opportunity to do well in various types of economic seasons. Next, we have to determine what our allocation is across each asset class. At the target allocation, the portfolio will invest 30% in U.S. stocks, 40% in long-term treasuries, 15% in immediate-term treasuries, 7.5% in commodities, and 7.5% in gold. Lastly, the portfolio is rebalanced once a year, so the positions are brought back to equal weight at the outset of every year. The all-weather portfolio provides investors with a relatively simple, straightforward portfolio to weather all different types of economic seasons.